Okay.
Good evening and
We'll
welcome.
start. Thank you. Hey, Mr. Mastibula, how are you?
Good evening, Doctor.
Good evening. Okay, so tonight we are going to discuss IAS 40, which is investment property. The last class we discussed PPE, property, plant, and equipment. So today we'll be discussing investment property. They are almost similar. So I will want us to go straight to the difference between investment property and PPE. We are almost going to apply the same principle in tackling investment property, the same principle, almost the same principles that we employed last week when we discussed PPE. Okay, so I want us to, go through, let's just go straight to know the difference between investment property and PPE. Okay, so investment property, we talk of land and building or part of a building or both that is held to hand renters or for capital appreciation or for both. Okay, so when you talk of investment property, you are having that property. It can be land, it can be building, it can be both of them for the purpose of handing renters, or for the purpose of capital appreciation. And it can even be for both. What is capital appreciation? You have land, for example. You are not doing anything with that land. You might acquire the land, keep the land there for the purpose of reselling the land when it appreciates in the future. So the purpose of you having that property is to earn income. You use it to earn income, okay? Either for immediate renters that will come into the future, or for capital appreciations, you intend to sell that property in the future. So that is the main purpose of you acquiring that property. And when you talk of PPE, it's quite different from PPE because PPE is referred to as owner-occupier property, where you had the property for use in your production, like equipment, or you have a building that you are using for administrative purposes that house your administrative staffs, where you run your company from. So it is not, you are not having that property for you to use that property to generate income. No, you have the property, it's just like a support property. You have a property that you use in the process of production. So it's in that production that hands you money. When you have a building used as an administrative office for a productive activities, okay, and it is what you produce you will now sell. So that building is owner-occupier property. It's not an investment property. So that is the difference between investment property is what you have that you use to earn income, generate income directly. If you have a land, it's either you rent out the land and start getting renters on that land, or you leave the land there for a while to allow it to appreciate. When it appreciates, you sell it off and make money. So that is the difference between investment property and owner-occupier property. Okay, so example, we have land held for long-term capital appreciation, land held for a currently undetermined future use. You have it there. Maybe you have not make up your mind on what you want to use that land for, so you just have the land there. and it's just for future use. Okay, building leased out under an operating lease. If you have a building that you lease out to people under operating lease, then building that is vacant, but it is held with the intention of letting it under an operating lease. So if you are not using the building now, or nobody is occupying the building now, but you have the intention of, giving it out, under operating lease. So all this one falls under investment property. Okay. The recognitions and the initial measurements all have, it's just like what we have with PPE. It is probable that future economic benefit will flow to it. All those definitions for recognitions, all the recognition criteria, the same way it applies to PPE also applies to investment property. Okay. We have initial measurement cost, including the transaction cost, then including any directly attributable expenditures such as legal services, property transfer taxes, and other transactional costs, excluding startup cost, initial operating losses, wasted materials, and unproductive costs. So these are those things we have. When we have the cost, we also look at what are directly attributable costs, such as legal services. We also look at those costs that will not be part of the initial measurement, like startup costs, initial operating losses, wasted materials, and non-productive labor costs. I think you need to go through all this. Then by the time we are solving examples, as they are showing up, then you can see the applications directly. Then you talk about the subsequent measurement. We have the fair value, we have the cost model. We also talk about the recognitions if such property is disposed and all that. Okay. This is the decision diagram. The purpose of this following decision diagram is to summarize which international financial reporting standard applies to different types of property. Now, if the property held for sale in the ordinary course of a business, if the property is held for sale in the ordinary course of a business, like inventories, if you produce whatever product, if you produce soap and you keep the soap in your warehouse for the purpose of selling it, that is an inventory. So you apply the inventory standard. Okay. If it is property owner occupier, that is PPE. You have to apply PPE standard. If the property being constructed, developed for future use as investment property, then you have to apply this property as an investment property. If it is for investment property, which model, either cost model, fair value model. Okay, so all this you will see how it applies when we go through examples. So all those other details you need to know about the standard IAS 40, you can go through your guidelines. Okay, you have different things to read about here. Definitions, the following terms are used in the standard with the meanings. I think we are familiar with those definitions. Carrying amount is the amount at which an asset is recognized in the statement of financial position. We have the cost, we have the fair value. That is the price that the asset can be sold in an open market, where you have the market participants, they are willing buyers and they are willing sellers. Then investment property, we have looked at it. It is the property, land or building or part of the building held by the owners or by the lease under a finance lease to hand renters for capital appreciations or both, rather than for use in the production or the services for administrative purpose, sell in the ordinary course of a business. Then we know what is owner-occupier property. Property held by the owner or the lease under finance for the use in the productions or supply of goods, services for administrative purposes. Okay. Yeah, you can just do all these details so that we save a lot of time. I want us to go straight into an examples and begin to give us the practical knowledge of what the standard is talking about. Okay, let's look at example 1. Tinta Limited is a holding company which is rapidly expanding. The company owns several properties that are occupied in different manners. The details are as follows. Property 1, Tinta Limited expanded its business to a small rural town and has bought an old house that was converted to offices. The business operated by Tinta Limited in this town is still growing, and the house is therefore not fully occupied by the company. The house has a small flatlet attached to it that is currently being rented out. The flatlet will eventually also be occupied by the business. Okay, by what is described here, who can tell me this property, is it an investment property or owner-occupier property? Let me read it again. Tinta Limited expanded its business to a small rural town and has bought an old house that was converted to offices. The business operated by Tinta Limited is in this town is still growing, and the house is therefore not fully occupied by the company. The house has a small flatlet attached to it that is currently being rented out. The flatlet will eventually also be occupied by the business. This property, how do you classify this property? Is it an investment property or owner-occupied property?
It is partly.
Investment.
Partly.
Owner.
It's an investment.
It's owner.
Somebody want to say something there?
It's an investment.
I'd say it's owned by the business. It's not an investment according to the scenario, I think.
Correct. That is the, if we look at you can see that they said Tinta Limited expanded its business to a small rural town and has bought an whole house that was converted to offices. When we look at the definition of investment property, it has to be, you have that property with the intended of using it to make income. It's either you have a house, you want to rent it out. Either you have rented it out now or you intend to rent it out later. Okay? That will be an investment property. But when you have a house, you have a building that is occupied by you, you are using it as your offices. So it's not an investment property, it's an owner-occupied properties. Are we getting it?
Yes, but
Yes,
but the second last sentence whereby it says the house has a small flatlet.
Yes. I want to talk about
out.
it now. It said the house has a small flatlet attached to it that is currently being rented out. The flatlet will eventually also be occupied by business. So, which means, I mean, definitely the proportion of this flatlet, will be very, very small compared to that building. But we are even told that even the flatlet will eventually be occupied by the business. So now that it's being rented out, now we cannot actually stop us from categorize this building as owner-occupier just because of the small portion that is being rented out. And it has also been indicated that even the flatlet will also be occupied by the business.
Okay.
Yeah. Is that clear?
Yes, sir.
Okay. Let's look at property 2. Tinta Limited owns a piece of land in Johannesburg. There is this possibility that this piece of land will be expropriated by the local government for the construction of a new road. Tinta Limited original intention with buying this land was to eventually construct its head office on the stand. Tinta Limited had decided to wait for the final decision of the local council before constructing the new office on this land. Is this land an investment property or owner-occupier?
Owner-occupier.
Owner-occupier, correct. Owner-occupier, because the intention of the owner has been revealed to us here. You see, he said the Tinta original intention with buying this land was to eventually construct his head office. But now that the local government is interested, so he wants to wait, for their decision, either they are going to take the land or not. But his original intention is to construct his head office on that land. Are you getting it now? So with that intention, it shows that it is not for investment purpose. Let's look at 3. Tinta Limited and all its subsidiaries are occupying a building that Tinta Limited owns. The subsidiary pay market-related renters to Tinta Limited. The building is occupied in the ratio of 30% to 70% by Tinta and its subsidiary respectively. So which means Tinta is occupying 30% of the building while the subsidiary are occupying 70% of the building. The intention is that Tinta and the subsidiary will move to the new head office once they have been constructed, and that the existing building will then be held until it can be sold for a market-related price. What is this building? Is it owner-occupier or investment property?
Investment property.
Pardon?
Investment property.
Yeah, this looks like an investment property. First of all, you can see that the ratio that the Tinta is using there is quite low, 30% to what the subsidiary is using. And we are told that the subsidiary are paying renters. Okay. Again, they also told us that they have the intentions, both the subsidiary and the owner, to move to a new building that is being built, and that this one will be kept until it is sold. So this is an investment property. From the two sides, we can look at it. Do we get it?
Yes, we do.
Yeah. Okay. Okay, well, I think we've almost answered. Classify the properties as either investment property or owner-occupier in accordance, in the account of record of Tinta Limited. I think number 1, property will be classified as owner-occupier property used in the supply of services. The supply of these services generates cash flow that is attributable not merely to the property, but also to other assets used in the business of Tinta. So the services supplied from this home office are the most significant component of the whole arrangement. The letting out of the flat to tenant is an ancillary service and does not change the classification of this building as owner-occupier property. I think we got that one. Property 2 will be classified as owner-occupier property. Paragraphs 9 of the standard state that property held for future development and subsequently used as owner-occupier is not investment property, but must be classified as owner's occupier property. The fact that there is uncertainty as to the ultimate use of this land because of the outstanding decision of the local council does not change the intention of Tinta to build its head office on the piece of land. Number 3, it will be difficult to classify property 3. Judgment must be used when determining whether this property qualifies as investment property in the record of Tinta. Tinta Limited must develop criteria in order to exercise judgment in accordance with the definition of investment property. The criteria applied must be disclosed when the classification is difficult. The fact that less than 50% of the building is occupied by Tinta itself and therefore used in the production of goods or service for administration means that the majority of the building is occupied by the tenants. So the building can therefore be classified as investment property. Okay, the possible change in the use of the future does not influence the classification of the property at this stage. I think we were correct in all the three stuff. Now we talk about recognition and initial measurement of investment property. Investment property shall be recognized as an asset when and only when it is probable that the future economic benefit that are associated with the investment property will flow into the entity and that the cost of the investment can be measured reliably. This is the general definition of asset. Okay, recognition of asset. Then an entity evaluates all its investment property costs at the time they are incurred. These costs include costs incurred initially to acquire the investment property, costs incurred subsequently to add to, replace part of it, or service a property. Okay. Under this recognized principle, an entity does not recognize in the carrying amount of an investment property the cost of the day-to-day service of such property. Rather, these costs are recognized in the profit or loss as incurred. So any cost that is involved for day-to-day servicing, like maintenance and others, will go into the P&L instead of capitalizing it. Okay. Initial measurement. These are how you measure it. First of all, the cost of purchase. Then, if the property is bought from an entity that is registered with VAT, then you have to remove the VAT from there because they will claim it back. Okay, all this we are going to. If any of our examples capture it, then we will. Okay, let's begin to see example of initial measurement of investment property. On 1st of January 2018, B Limited acquired an investment property at 900,000. The full acquisition price was payable on 1st of January 2018, but as B Limited was experiencing cash flow problems, the seller agreed that 50% of the amount be paid immediately and the remainder at 1st July 2018 without charging any interest. This prolonged period exceeds normal credit terms. B Limited also paid transfer taxes of 55,000, while unproductive labor costs amounted to 25,000 rand. A discount of 12% per annum before tax compounded annually is regarded as appropriate. Okay, now we want to determine the initial measurement of this property. What is the value that you will have to record in your books at this particular time? Now we were told that the total cost of the asset is 900,000, but this amount is supposed to be paid almost immediately. That is 1st of January 2018. But the company is experiencing cash flow problem, so it can only pay half. So the seller agreed that 50% of the amount be paid immediately. So the guy paid 50% of 900,000 immediately, which is 450. Then the remaining 50% will be paid in 6 months' time. You can see it will be paid at 1st July. This is 1st of January, then 1st of July. So which means for 6 months' time. Now this is above the normal credit time. Normal credit terms is taken to be 30 days. So when it's above normal credit times, just remember, like what we did last week, you are going to determine because you need to record that price in your books now. So you need to determine the present value of that amount you want to pay in 6 months' time. You must have to capture the present value now. That is why all that details, when you have your questions and you have all that details given to you, you are being given the interest rate, then you should know that definitely you are going to calculate the present value of the half of that money. So to calculate to do our initial measurement of this property, the cost paid, if you look at the solution here, the cost paid on 1st of January is 50%. It was able to pay 50% cash. But the other 50%, you have to determine what is the current value now, the present value of that amount. The future value is 450. So you have to use your commercial calculator to determine the present value now. Okay? So you have all the variables here. We have the numbers is equals to 1. We have the interest rate is 6, because the interest rate per annum is 12%. So for 6 months will be 6%. So it's 6. The future value is 450. Then you have to compute your present value. Okay, so when you have to compute your present value, then it will give you 424,528. So that will be the present amount the present value of the future amount you are going to pay. The difference will now be the interest. Okay, then the transfer taxes. If you look at those story we had before now in the under initial measurement, you find out that transfer taxes, if you have a transfer taxes, is part of the cost that is directly attributable to the cost of that property. So you have to add it. Then you have unproductive labor cost. That one is not to be added. It's not to be added. So please, we have those. I think we have seen those ones under initial measurement the other time. Let me quickly.
Sir?
Yeah?
What would be those unproductive labor costs?
Unproductive labor cost. Let me think of one. If you are talking about maybe if you talk about land, for example, maybe the cost of getting a security guard there. I'm not sure now. I've not actually get on security guard there to guide the land pending when it will be sold. Whether that one could be regarded as unproductive labor cost. So maybe they may not allow you to add that one to the cost of that land or whatever. Or I'm not so sure
okay.
now. Maybe I can just work on that one and come back. Yeah, I'll work on that one and come back to the class. But I'm sure the question will be very clear in describing the cost, so that we will know that that should not be added to the initial measurement. Okay, so here now we can see that the total cost that we are going to book on 1st of January will be 929,528. Let's look at another example. Or any questions as regard that one? Okay. Peregrine Limited has bought a property from a registered VAT vendor, of which the details are as follows. The cost, including VAT, is 695,400. Agents commission, legal fees, expenditure incurred to upgrade the property before occupying it. Then Peregrine Limited is a register for VAT, and the current VAT rate is 15%. The expenditure incurred was necessary because of the neglected state of the property at the date of acquisition. So you can see now that the question also have to justify the 73,000 there. So you ought to know that that is a necessary expenditure. Then the intention of the Pelegri is to rent the property out and earn a rental income from it. Pellegrin Limited incur cost to the amount of 18,000 to secure tenant. Calculate the initial price that the investment property must be recorded at. Okay. So when you have a cost that's including VAT, you have to remove the VAT because the VAT will be claimed back by the company since it's registered with the VAT with SARS. So the cost is 695, then the VAT claim back. So you have to, the VAT is 15%. If you want to find out the amount of VAT inherent in that price, it will be 15 divided by 115. Okay? If it is 10%, 10 divided by 110. Okay? So you have, that is what you will do to get the amount of VAT in that price. So which is 9704. You have to remove it. Then the agent's commission is part of the cost that is traceable to the investment, the legal fees, then the expenditure incurred to upgrade the property. Everything will be put together. Okay. Now we can say that this cost, the cost to secure a tenant, we can't, the cost to secure a tenant to that property, you cannot go and add it as part of the cost of the property. Okay. So this is how to determine the initial cost of this property here. So this one demonstrates how we can handle issue of VAT if the questions so clear about the VAT element of it. And we were told that the company is also registered company with SARS. Okay, any questions here?
No, sir.
All right. Then subsequent measurement. You know, we talk about initial measurement. Now we talk about subsequent one. Later, how do we measure it? We can use fair value model. We can continue with the cost model. You know, fair value model is, you know, in PPE, we call it the valuation model. For here, it's called it fair value model. That is, what is the current state, what is the current market value of that property? If the company chooses to measure their properties using fair value model, the question will let us know. If it is through cost model, then cost model is the normal model, that is the cost less accumulated depreciation or less any impairment. Okay, so the question will be so clear. When you talk of fair value model, you are talking of now finding the difference between what is the value of this asset at this, maybe at the beginning of the year, what is the fair value model that is disclosed now. We now look at the, you know, the fair value surplus, either gain or loss. It's like evaluation surplus, evaluation loss. Okay, so fair value model, fair value is defined as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Okay, the fair value effect, rental income from current leases, other assumptions. So please just go through it. Then this example will also help us to understand it quick. So let's look at this example on fair value model. City Limited owns an office building that is let to Z Limited under an operating lease agreement. As the building is used to generate rental income, it can be classified as investment property in terms of IAS 40. City Limited has adopted the fair value model as its accounting policy for measuring investment property. Now, the building has a useful life of 40 years. The following fair values were applied on acquisition. January 1st, 2017, the cost is 400. Now, December 2017, the value is now 600. 31st December 2018, the value is now 500. Okay, 1st of January 2017, City recognized the building at a cost of 400. Okay, now, you see now, the initial cost is 400, but you can see that because this company adopt fair value model. So on December 27, 2017, it's like the value the land, is it the land, the value the building, they now find out that the current value of the building now is now 600. Now, December 2018, a year later, the value is now 500. So this is fair value model where you have different value, and what you need to find out is either there's a revaluation, fair value surplus or fair value, loss. So on December 2017, City Limited had to remeasure the building at a fair value. The remeasurement is recognized in the profit or loss section of the statement of profit or loss and other comprehensive income. So the difference between the cost and the new will be recognized as either profit or loss. Now let's look at the solution. You can see the fair value for measuring investment property, 31st December. So at the end of that year, the building was acquired 1st January 2017. So at the end of that year, when you are finalizing your books, you can see that the investment property is now 600 minus 400. So we have fair value adjustment which is 200. Fair value adjustment, the one we will refer to under PPE as our revaluation surplus. Okay? So here it is fair value adjustment that will go to our other comprehensive income in P&L. Then you are debiting, the initial cost is 400. So you debit investment property, the value with 200, the value now becomes 600. Then you now credit fair value adjustment. So, and it's a remeasurement of investment property at a fair value. Okay. Now, on December 2018, C Limited once again remeasured the investment property to a fair value with the loss being recognized in the profit and loss of the statement of profit and loss. Okay, you can see December 2017. No, this one supposed to be 2018. December 2018, because we just did this is 2017. 2018 now, we now have the value is now a loss. So it means the value of the investment property will be reduced. So you are crediting investment property and you are debiting fair value adjustment. That is 500 minus 600. So revaluation, this is loss now. Then you are debiting fair value adjustment and you are crediting investment property because you are reducing the value. Okay, so this is how you deal with fair value model. So this is how you deal with fair value model. Okay, we are still going to do more examples. You are still going to encounter more examples on fair value models. Any questions? So the fair value is what for you to consider. First of all, you consider the cost and the current value, just like that. So you kept comparing the values. Is it gain or loss? And you're just making your adjustment in that regard. Okay, any question? All right, let's continue. Then investment property held as a right of use asset. As a right of use asset. This one is when, you see, if a lessee leases a property and hand rental income by leasing the property to another lessee, sublease, the resulting right of use asset should be accounted for as investment property. Okay, so if I got a lease from a company, okay, I got a property on lease from a company, and that same property, I also gave it, to another, I sublease it to another company. I hand income on it, rental income on it. In my own books, I would treat that asset as a right of use asset. I think we'll make use of these terms by next lecture when we'll be discussing lease. So the guy is not the owner of the property, but he has a right of use of that property. So in his books, he will consider that right of use as an investment property because that property itself belongs to the original owner. He just leases it from the original owner and sublease it and hand rental income from there. Okay, so that is what is right of use. In his books, it will be right of use asset that he will be accounting for it as an investment property, not the physical property. So the asset accounted for as an investment property is not the physical property, but the right of use asset, the lease interest in that property. So the physical property will still be accounted for as an asset in the owner's financial statement. So if the fair value model is applied, the right of use asset should be measured at a fair value and not the underlying property. So let's look at an example. Chelsea Limited leases land with a fair value 1 million rand for a period of 3 years at an annual market-related rentals of 100,000 payable in arrears. The land was leased to Alpha Limited for the same period under an operating lease at 125,000 per annum payable in arrears. Both lease agreements were entered into on 1st January 2013. Chelsea Limited account for the lease liability by using an incremental borrowing rate of 6% per annum. Assume a fair discount rate of 4% on 31st December 2013. Okay, so we understand it now. Chelsea is not the owner of this land. He leases it from one company and sublease it to another company, to Alpha Limited. So how will Chelsea record this in his land and at what measurement? Okay, so now in his book, Chelsea books now, we are going to see this journal, you raise this journal entries. First of all, the total rentals is 100,000 per year for 3 years. And like I told you, once you are given some details in your questions, it should prompt you to know that you need to, while you are recording, this is 1st of January, the lease agreements were entered into 1st of January, and you are booking, you want to book your, you want to update your records as of 1st of January. Okay, you can see that the investment property here is debited with the present value of the total 300,000 for 3 years. You are expecting 100,000 per year for 3 years. Okay, so in your journal, you debit the investment property you know, that investment property here now is the right of use, because we are dealing with Chelsea's record now. So it's the right of use that Chelsea has on that land. It's sublease it. So you still debit investment property with the present value of 300,000. I mean, the present value. So how do you determine the present value? We are given the payment. We are given the number is 3 years. The interest rate is 6%. The present value, you will determine, use your commercial calculator. Okay. So you debit investment property with the 22,67301, then you now credit finance lease liability. Remember that he leased it from another company. Okay, so by next week we'll deal with lease, in details. So you find out once you create a right of use, immediately you may also create the corresponding liability. Okay, so here now is debiting the investment properties. It will also create the finance liability, because this is also owing. This is what is owing the original owner of that land. So the recognition of the investment properties. Then on December 2013, December, we can see the finance. On December 2013, that is, one renter is due. You know, the renter is annually, 100,000 annually. So December 2013, one renter is due. So how are you going to record it? You have to debit, you have already credited finance liability with the total present value here. So when the first installment is due, you want to be reducing the liability by the installment paid. So you debit the finance liability with, the amount you pay is a function of the principal and the interest. We'll get the details next week. It's a function of the principal and the interest. So here, the 100,000 is a composition of both the principal and the interest. So when you look at the interest, the total amount, the present value is 2,67301, and the interest rate is 6%. So when you find the 6%, so it means you debit the finance liability with the principal, which is because this is the amount we are using to reduce the liability. This interest you are paying will go to a P&L. Okay? So interest paid will be 16 days. Then you credit your bank. You are paying from your bank. So you are paying 100,000 at the end of the year, but this is the total component of, that's the interest element and the principal of that 100,000. Then remember that you are also getting,
Sir?
Yeah?
Sorry, can I just ask something quickly?
Go ahead.
So when you are going to do this practically, you first have to calculate the interest paid and then deduct that interest paid from the finance liability.
Yes.
Okay,
Because
thank you.
By next week it will be very clear, because when you are paying renters, you are paying both the principal, the amount you borrowed or the amount you owe, and the interest element of it. So most of the time you have to separate the two, because it is the amount the principal that will reduce the amount you owe. The interest is just it's an expense that you incur for, paying, for that agreement. So it's not going to have any effect on the principal. So most of the time, the interest, the lease payment will be separated into principal and interest. We will have the details next week. Next week we are dealing with lease proper. Okay. No, on the same December 2013, you know, this guy, this Chelsea also subleased the lands to another lessee. So, and his own is getting 125. If you see the question, you see, the land was leased to Alpha for the same period under an operating lease of 125 per annum. So the guy is so at the end of that, he will get his bank, he will get a rental income of 125. Now, the receipt of the installment. When you try to get you want to see the present value of that 125. The present value of that 25 come to 235. You now see that this is where the fair value comes in. The present values with 100,000 is giving us 267,301. When you do the present value for 125, that is the sublease, is coming to 234,732. Then there's a fair value adjustment here of 31,539. So we start the investment property being credited with 31,539 and credit the fair value adjustment with for the difference between the 267,301 and minus 235,762.
Sir?
Yeah?
I think I'm confused a little bit, or a lot.
Okay.
From
where?
Okay, the books that are being prepared now are Chelsea's books.
Yes, it's Chelsea's book.
Okay, and now, where does he involve the subleasing? Because he rented out, Chelsea leases a land, he leased a land to somebody else who subleased it.
No.
Am I getting it or what?
No, get it. Chelsea leased the land from somebody. That is why he's not owner of the land.
Oh, he's the one who
yes, because we are treating right of use asset. Chelsea only has right of use asset.
Okay.
That is why first of all we need to do as an accountant is to first of all establish what is the total liabilities for Chelsea. What is the total finance lease liabilities is having? How much is owing to the company where he originally leased that property, that land. So that's what we did.
So Chelsea is the one who is leasing the land, and then he is subleasing it to Alpha Ltd.
Exactly. He's the one, he leased it first from one company, and he now subleased it to Alpha.
Okay. So the books that we are preparing here are Chelsea's. Okay.
The Chelsea books.
All right. Because I was a bit confused.
Yeah, it's Chelsea books. So that is why, first of all, you first of all credit the right of use. What the right he has on this land is what is called the right of use.
Right of use.
So you debit the investment property and you establish the total liability, the total financial liability. That is our first journal here. Then at the end of that year, he needs to settle the first installment. That is what we did here. Then himself, because he also
I think, excuse me, sir.
Yeah?
Excuse me, sir. Okay, I think I understand that part, but now where I was a bit confused is when it comes to a rate. There's a 6% rate per annum, and then there was that a fair discount rate of 4%. So yes. I think I got lost a bit when I got to that one.
Yes. They said Chelsea account for the lease liability by using an incremental borrowing of 6%. Assume a fair discount rate of 4% on 34 December 2013.
Mm-hmm.
Yes. If you look at here, we use, for its own fair, we use 6% here, January 2013, to determine the finance liability. The present value of the finance liability, we use 6%. But now that December 2013, we want to find the present, the present value of the payment that is receiving from the sublease.
Mm.
Yes, that because of we have to use interest rate instead of using 6%, we have to use 4% here to determine this 235.72, because the question was saying that assuming the fair discount rate now is now 4% on 34 December 2013. Here, they said both lease agreements were entered to 1st of January 2013. Chelsea Limited account for the lease liability by using an incremental borrowing of 6% per annum.
Mm.
Then assume a fair discount rate of 4% on December 2013. So determined on December 2013, here see our journal entries here. This is first to determine the total liability, the present value of the liabilities. We use the 6% rate, and for the December 2013, for its own payment, is receiving, we use 4% rate to determine the present value of his payment, and that's what we have here. And I don't want to get worried about this because this example is just telling us how we handle right of use. But most of the questions we are going to handle, we show us the specific rate that we need to use. Okay, so it can give you two different rates, but just for explanation purposes, to know how we treat that, how someone can update his record, someone who is not the original owner of that property and just have a right of use, to that asset. That is what is explained with these examples. Just try to know first of all evaluate the total finance lease liabilities using your present values mode in your calculator to determine. Once you are given a question that is giving you a discount rate, they call it interest rate, they call it borrowing rate, you are going to find since this 100,000 is coming up at the end of the third year, so then at the end of the year, you start bringing in the renters one after the other. Then you also consider the renter that the company that has the right of use, the renter that is also getting from that asset. So how you also deal with it here. So this is remeasurement investment part to a fair value. Okay. And as we go ahead, we will see many examples that will make it more clearer to us. Inability to measure fair value. So if you cannot measure fair value, then we will use a cost model. Okay, if the question says they cannot determine the fair value, then we'll go ahead to use the cost model. Let's look at this example. On 1st of July 2018, B Limited acquired a land at a cost of 400,000 with the intention to build an office block on it at a total cost of 600,000. At year-end 31st December 2018, the construction of the office block was not completed. Construction costs incurred to date amounted to 450,000. On 31st December 2018, the fair value of the investment property under construction, including land, amounted to 900. Okay. We have this company acquired, B Limited acquired a land costing 400,000. That's the initial cost, with the intention to build an office block on it at a cost of 600,000. At the year, the construction of the office block was not completed. The construction cost incurred to date is 450. You can see the construction cost incurred to date is 450. The initial cost is 400. They intend to spend another 600,000 on building to build the office block, but they ended up spending 450. So which means the total cost so far will be 400 plus 450. But we were told that on December 2018, the fair value of the investment under construction, including the land, is 900. Okay, so the total cost is 400. So there's a fair value adjustment here. Let's look at the solution. Construction of investment property. On 31st December 2018, B Limited recognized a fair value adjustment gain of 50,000, which is 900 minus 400 plus 450. Okay, in the profit or loss, in order to reflect the investment property under construction at its fair value. If the fair value of the investment property under construction could not be determined reliably, if the fair value of the investment under construction could not be determined reliably at that date, no fair value adjustment would have been recognized, and the property would have been reflected at its cost of 850, which is 400 plus 450. I hope you understand what they are saying here. Okay, you know, we are treating these examples under if inability to measure fair value. So that is what this example is explaining to us. If the question says they cannot, they are unable to measure the fair value, then we will go with the cost model, which here, the cost here is that the initial cost of the land is 400, but the construction to date has also cost 450. So it means the total cost will be 850. But now they said the fair value is 900. So there's a fair value adjustment of 50,000. So that's what this is explaining to us. But if they said there's not, they are unable to measure the fair value reliably, then we are going to go with 850,000. Okay. Yeah, this is just other story, just telling us what is fair value. How do you, we have willing buyers in arm's length, willing buyer, willing seller, open market. This is how you determine a fair value. Then you talk about cost model. We all know cost model. Cost model is what we, cost model is just the original cost, less your accumulated depreciation. Okay, so we have an example here. Company A followed the alternative method of recording property, plant, and equipment. The plant was revalued to 75,000 on the net replacement value basis in the current year. At the date of revaluation, the details of his plant were as follows. We have the plant original cost, we have accumulated depreciation, we have net replacement value of 75,000. Required, journalize the revaluation, ignore tax and depreciation. So this is a pure revaluation stuff. Okay. We have the plant revalued 75,000, the accumulated depreciation. The plant cost is 100,000. So if the plant cost is 100,000 and the accumulated depreciation is 40,000, which means the carrying value will be 60,000. So if the carrying value is 60,000 and now it is revalued for 75,000, so the revaluation surplus will be 15,000. I think it's clear. You know, the normal evaluation stop. You mean your cost model, the cost less accumulated depreciation. So the cost here is 100,000. The accumulated depreciation is 40,000. So our carrying value will be 60,000. And now it is valued at the plant was revalued for 75,000. So which means we have a revaluation surplus of 15,000. Okay. Cost model for measuring investment property, example 8. X Limited commenced erecting a building on 1st of January 2017. It is the intention of the entity to rent the building to third parties on completion. So the following erection costs were incurred during the year ended 31st December 2017. We have the material, labor, other professional costs. Then the total cost is 550,000. X Limited adopted an accounting policy to measure investment property using the cost model. The useful life of the building is 55 years from the date of completion. The property was completed on 30th June 2017. It will therefore be depreciated from 1st of July 2017, since it was ready for its intended use on this date. So on December 2017, the market value of the property is 800,000. The market value is 800,000. Okay. So the cost model for measuring investment property, the following journal entries are required for the year ended 34 December 2017. We have the investment properties, 550, the bank or stroke liabilities, 550. Recognizing investment property under construction at cost incurred to date of completion. Okay, we have the total cost is 550. So you debit your investment property and you credit either if it is a liability, if you assuming you lease it from another company, it will be a liability. If you are the owner, it will be your bank. Now, accumulated, we have to look at it. You know, when you talk of cost model, you talk of a depreciation. Depreciation is, we have 550 divided by, it is useful life is 55 years. Then multiply by 6 months, because the depreciation starts from 1st of July. So 1st of July 2017 to 31st December 2017 is 6 months. So the depreciation for 6 months is 5,000. Accumulated depreciation is 5,000. Provide depreciation on investment properties. Okay. So, and you know, the question is saying on 31st December, the market value of the property is 800,000. But we have been told that the company has chosen to measure on cost model, not on fair value model. So that's why this 800 is not taken into consideration. It's on cost model. So on cost model is just to determine the cost and the depreciation involved. Note that the investment property under construction was accounted for by applying the cost model because the entity adopted the cost model as its accounting policy for measuring investment. Should the entity have adopted the fair value model, it will measure the investment property under construction at a cost until the fair value becomes reliably determinable. Okay, then the recognition. The recognition the same way, you'll be treated the same way we did under PPE. The recognition is when that particular asset is disposed of. Okay? An investment property shall be derecognized, eliminated from the statement of financial position on disposal, or when the investment property is permanently withdrawn from use and no future economic benefit are expected from its disposal. Okay. Then we have subsequent expenditure. Then this is an example of the recognition of investment properties. On 1st July 2018, B Limited acquired an investment property at 600,000. On 31st December 2018, the year end, the fair value of the investment property amounted to 700,000. On 2nd January 2019, the investment property was sold for 725. So this is an example of the recognitions. So what do we do? 1st of January 2018, when it was acquired, you have to debit investment properties and credit your bank or liabilities as the case may be. Okay. 34th December, we were told that on 34th December 2018 year end, the fair value of the investment amounted to 700. So we have fair value adjustment. So you debit investment property with 100,000 because the difference between 600 and 700, the new fair value now is 700. The difference is 100. So you debit your investment property with 100, so that the value will be 700, and you credit fair value adjustment with 100. Okay, this is the remeasurement of investment properties. Then we were told that on February 2019, the investment property was sold. So 2nd January 2019, bank, the investment property was sold. So if you sold, your bank will be debited. You debit your bank with 725. The profit of the sales of investment is 25. The value of that asset as at December 2018 is 700, and now it was sold for 725. So the profit on the sales of property is 25. The investment property will be credited 700, and the account of investment property, the ledger will be 0. Okay. So this is the recognition of investment property. So this is how you treat the recognition. Okay. Then you now have disclosure. You can read the details about the disclosures. How can you, in case you are asking, what do you need to disclose under fair value model, under cost model, and all that. So you can read all this. Yeah, we now have to deal with the comprehensive examples now. Okay, just please give me 1 second, 1 minute. Okay, so let's look at this comprehensive example. Baroka Limited is a manufacturing company and its year end is 30 June. The following details are available relating to its fixed property. Number one, land situated at stand 88 Mayfair with an original cost of 100,000 was originally bought on 1st of April 2012 for capital appreciation. So you know that this is an investment property. It was bought for capital appreciation. So the area in which the land is situated has become very popular. And on 1st of May 2013, a property developer approached Baroka Limited to buy the land from it. The developer offered Baroka Limited 280,000 for the piece of land. The fair value of this land on 30th June 2012 was 145. Baroka Limited had decided to accept the property, developer offer. Okay, I want us to be looking at each of these situations, and so that by the time we get to the solutions, we will not lose track of those questions. In this case now, the cost of this, what is the original cost of this asset?
$100,000.
100,000. What is the fair value? What is the fair value of this asset?
When?
It was 145,000.
145,000, correct. So here now we have, what is the fair value adjustment we have here?
The fair value of this land on the 30th of June.
Of
2012.
45,000.
Yes,
Our fair value is 45,000 because the cost is 100,000. Our fair value is 45,000, and the fair value at the end of 30th June, at the end of 30th June 2012 is 145. Okay, and we were told that the fair value of the land on May 13, the property will approach the land from it, developer. Okay, then we were told that the developer offered Baroka 280 for the piece of land. So the fair value of this land on 30th June 2012 is 145. Then on May 2013, we can see that it's like the land was sold because they said the property developer approached Baroka Limited to buy the land from it. And the latter part of the question told us that Baroka Limited has decided to accept the property developer offer. Okay, so these are the details contained in these first situations. So let's go ahead. Just want us to be looking at the details questions. Now let's look at the second situation. Baroka Limited owns a property in Santin situated at stand 33, which was originally purchased on 1st of July 2012 for 1.8 million. The value of the land at that date was 500,000, and the office building is 1.3. Okay, it's 1.3. This property is rented out in full under a 4-year operating lease agreement since the date of acquisition. There are 2 tenants occupying the building, and the monthly rentals receivables from them is 10,000 and 18,000 respectively. Baroka Limited repainted the building during the current year as part of its general maintenance program for the building. The cost of repainting the building amounted to 42,000. At the year end, the fair value of this property was to be 2,010,000, which is 600 land and building. Now, let us also look at this question. The original cost of this, this property is divided into two now. We have land and building. The total cost of it is 1.8. The land is 500 and the building is 1.3. That is the original cost as 1st of July 2012. But there are other stories that were told in the middle, which will not necessarily concern us. We are going to make use of them, not under when we are treating investment properties, maybe when we are treating other, maybe P&L, whatever, because we were told that there are two tenants occupying the buildings and the monthly rental receivables is 10,000 and 18,000. That will go to P&L. It's a P&L issue. Then Baroka Limited repainted the building during the current year as part of its general maintenance program for the building. The cost of the repainting the building amounted to 42. This is also a P&L issue. Okay, these are expenses. Then at the year end, the fair value of this property was to be 2,010,000, which is 600,000 and 1.4110. Zero. So it means if you look at there's a fair value adjustment here now. The initial cost is 1.8. And now the fair value is 2.10. So the difference will be the fair value adjustment. Agreed?
Yes.
All right. So let's look at the other property. Baroka Limited owns property in Albertine, situated at stand 55, which is being constructed for future use as an investment property. The cost of the land on 1st of January 2012 was 400,000. At 30th June 2012, the construction cost to date amounted to 1,420,000. The construction of the office building was completed on 30th June 2012, and the initial cost of constructing this building amounted to 1.7. This is also the fair value of the building. Okay. There was no abnormal usage of materials. No depreciation is written off on the asset. Baroka was able to secure only one tenant for the new building by 30th June 2013. Additional capital expenditure of 38,000 was incurred during May 2013 in order to secure this tenant. Additional capital expenditure. So we were told that it is capital expenditure. The office building is leased out in terms of an operating lease agreement since 1st June 2013 for the next 5 years. On 30th June 2013, the fair value of the building was determined to be 1.840 and that of the land to be 480. Okay, so here we also have the cost. We have the different valuations which we are going to take care, we are going to look at. The cost of the land initially is 400,000. The cost of construction to date at the time, at the 30 June, is 1.4. And later, the cost of the building was completed and the total cost rose to 1.9. So this is also the fair value of the building. Okay. Then on 30th June 2013, the fair value of the building was also determined to be 1.8. So we have different levels of valuations here, fair valuations here. So we will see how we will deal with them. 4. Baroka Limited owns an office building in Randburg, situated at stand 11, that occupies for its own business purposes. The original cost Date of acquisition is 1st July 2010 of the property was 1.2 million, of which 180 of the cost can be allocated to the land. The building is depreciated over 20 years. The residual value of the building will remain at nil. Is this investment property or owner occupier?
It's owner occupier.
This is owner occupier. So you have to identify it. You can see it now because we were told that Baroka Limited owns an office building in Randburg situated at standing level that it occupies for its own business purposes. So this will be treated as owner occupier, where the initial cost take away your depreciations and all that. Then Baroka Limited applied the fair value model to investment property and the cost model to its property, plant, and equipment. Okay, we were told that this is the policy he used. For every investment property, it applies fair value model. But for every property, plant, and equipment, like the equipment, like the office building in number 4, that one is property, plant, and equipment. All valuations were performed by P. Talks of Val, a firm of independent sworn appraisers. Mr. Toko, the recognized and relevant professional qualification and has recent experience in the location and categories of the investment property being valued. The fair values were determined by reference to the current market. Profit before tax for the year ended 30 June 2013, after taking into account the effect of all the above information, amounted to 500,000, and in 2012 it is 400,000. Okay. Disclose the above information in the statement of financial position of Baroka Limited on 20th June 2013 and in the note for the year ended on the date. Okay, so we are to disclose in the statement of financial position, which means you are going to show what is the total values of investment properties, what is the total values of PPE, okay, under asset. Then we are told that comparative figures are required. Comparative figures are required. So we are going to look at, if we look at most of the questions, we have 2012, then we have 2013. We have 2012, we have 2013, okay? So we are going to look at 2012, 2013. Okay, so let's see how we tackle a question like this. This is the solution. But before you come to the solution, because this is how it will appear in the statement of financial position, Baroka Limited statement of financial position as at 30 June 2013. You have your asset, property, plant, and equipment, then you have your investment property. But to arrive at this, you must, then these are the notes, accounting policies, how you prepare your notes on these things, profit before tax and all that. But before this, we must have to, first of all, determine, get your calculations right. What under, to determine our fair value adjustment, how we are going to put everything together to arrive at that summary we saw in the statement of financial position. So you first of all have to determine 2012, 2013, 2012, 2013, because we are to do a comparative presentation. Now, property 1, we can see the other time that the cost on 1st of April is 100,000. We can see the format, the total, the cost, the fair value adjustment. The cost on 1st of April is 100,000. The fair value adjustment is 45. And the carrying amount on 30th June 2012, the carrying amount on 30th June 2012 is 145. That is, this is the 100,000, this is the fair adjustment. The carrying value is 145 under the total. Then we were told, since the disposal now, because we were told that on somewhere in 2013, that's the first one. On May 2013, the property developer approached Baroka to buy the land. And we were told that later Baroka accepted that offer. So on May 2013, we will consider, because the fair value was on 30th June 2012. And on May 2013, somebody approached the owner to buy the land. So we now, and he later accepted that offer. So that's why you see that disposal there. That on carrying amount of 30 June 2013, this asset is no more. So the disposal, 145,000. So the account, I mean, this is recognized, has been recognized from the record. So we'll see how we are going to put it together when we are putting together investment properties. Okay, so this is about property one. Are we clear about this?
Yes, sir.
All right. Property two, we see the cost also. The cost is 500,000. The fair adjustment, the carrying value at 30 June 2013 is 600,000, which means the fair value adjustment is 100,000. Very clear. This property two.
Yes, yep. Sorry, sir. Property number one.
Yeah.
Something that is not clear, because it says disclose the above mentioned information in the statement of financial position of Baroka on 30 June 2013. And then
should I go there?
Sorry?
I said, let me go there.
Yeah, and then
is he here?
Yeah. Yes. And then what happens to the amount that was offered?
Oh, okay. And the amount that was offered, that will be dealt with. The amount that was offered is 280.
Yes.
We can see that the carrying value of this asset as at the time of disposal is 145.
Yes.
The difference between 280 and 145 will now be profit on disposal, which will now show forth in your P&L.
Oh, not here. Okay. Because I was wondering, I thought it was going to be dealt with immediately.
No. It will be dealt with. I mean, you will now know that when you are preparing the note for your profit and loss, then this will come in as a profit on disposal. That will be different between 280 and 145,000.
Okay. All right.
Okay. So let's look at property three. Property three, we saw that the other time property.
Property two office building. That's
property two office building. It was divided into two. We have the 600 and the 1.3. So this also, the cost is 1.3. The fair value adjustment, the cost at 30 June 2013 is 1.4. Okay, so what you need to do, the essence of this is for you to now be able to organize all the investment property together and the fair value adjustment. You will see by the time we get to that investment property. Then property three, the land component of it is also 400. The fair value adjustment is 480. I mean, it's 80, and the fair value at the 2013 is 480. Then property three, the building aspect of it, we can see that the building aspect of it, we can see property three. We see that we have I want us to go to this property three. He has a lot of this place. We can see here that Baroka Limited owned property in Albertine, which is constructed for future use as an investment property. The cost of the land is 400, and the cost of the added at 30 June 2012, the construction cost to date is 120. Okay, 1.420. Please note that. The constructions of the building was completed on 30 June 2012, and the cost of the construction moved to 1,790. What is the difference between 1,420 and 1,790?
It's 370.
370. 370. He has moved 370 here. Then we also told that additional capital expenditure. When you see capital expenditure, so it's also will be part of the cost. But at the end of the day, we were still told that the building now end up is 1.84. So we also know how to find out the difference between this one plus this, then minus this. So I just came back here so that you know how those figures came about. So if you check this,
meaning this 12,000 of which is fair value adjustment, it's something similar to that balancing figure when we were doing other things.
Yeah. So the carrying amount of 30 June is 1.4. Addition to the construction is 370. Then another addition is 38. When you now look at 1,420 plus 370 plus 38, and we now have carrying amount at 30 June 2013 to be 184. So the difference is 12, which is the fair value adjustment.
184. Okay. Yes.
All right. Okay. So that is.
Yeah.
Property 4. Property 4 is the one that is the one that that is property, is PPE. It's not investment property. You remember, this one is not investment property. Okay, so the land is just the cost. There's no fair value adjustment because it is a PPE. We are using cost model. Then the property, the building aspect of it is the carrying amount is 918, the depreciation is 51, the carrying amount 2013 is 867. 867. Okay. So let's now, this is the calculation. This is how you just do your calculation to be able to determine the fair value, the cost, the fair value adjustment. And let's see how we are going to put all this together. Now,
wait, the property for land. Yes, I understand.
okay, so this is the calculations. Now let's look at investment property, how we put all this together. Okay, look at, no, you know, you are doing your note. The question is asking for us to do statement of financial position. So what we are doing now is, how do we arrive at this figure? That is the essence of doing your calculation somewhere, and now has to prepare the notes, you know, for the financial. You have to account the note on PPE, the note on investment property, then the profit before tax. So the PPE now, we only deal with what's it called? The property number 4. Then investment properties now. Let's now look at all those calculations, how we put them together. Okay, now we are doing a comparative analysis, 2012, 2013. 2012, 2013. So let's carrying amount at the beginning of the year. Property 1, if you look at property 1, do we have, when property 1, let's look at, can we go to our calculation? Property 1, the cost is 1st of April 2012. The cost is 1st of April 2012. And you know our year end ended 30 June 2012. So if your year end is 30 June 2012, when will the financial year begin?
1 May.
1 July.
The financial year will begin when? That will begin
1 July.
1st July
2012.
No, 1st July 2011.
Or okay.
Yeah. The financial year will begin 1st July 2011. Is that correct?
Yes, if it's ending.
So if it is 1st July 2011, it means this asset, this land was purchased during the year.
Mm.
You know, if you purchase a land during the year, it will not have a carrying amount. It will only have it will just be an addition. Do you get it?
Mm.
You know, you
mean it won't have appreciation addition?
It won't have, look at this carrying amount at the beginning of the year. Property 1 will not have carrying amount because it was purchased during the year.
During the
Okay.
year. Anything that's purchased during the year is an addition.
Yeah, it's an addition. So we now have carrying amount is, you know, we are starting from 2012 now. Carrying amount is Dutch for property 1. Now, additions resulting from acquisition. Our additions. So we now look at your calculations and bring all the additions. We have additions, property for 2012. Let's look at our calculation. For 2012, we have additions here, which is 100,000. But even this one has been, this one, for 2012 is still 100,000, is still there. For property 2, this property 2, this was, the cost is 1st July 2012. 1st July 2012. This is the beginning of another year. Yeah. For property 3, for the land, 30 June 2012, this is the end of the year.
End of the year.
We have property 1 and property 3. Addition resulting from acquisition. Property 1, property 3, that is 500. Let's look at it. Property 1 is 100,000. Property 3 is property 3 is what of the land? Land cost 30 June 2012, which is 400,000. So for land and this is also bought during the year. Do you agree? 30 June, exactly the end of the accounting period.
Sorry, sir, but which year end are we working on here?
We are working on 2012. You know, we are doing comparative analysis. So we start with 20. We are starting with 2012 now. We are dealing with 2012. Later we move to 2013.
Oh, okay. All right.
Yeah. So we are looking for this is 1st July 2012. No, this is the first one is April 2012 within the year, 100,000. The other one is for property 3, which is the land, which is 400,000. So that is why here you can see that for 2012 now, the 2012 is the first column. So carrying amount is Dutch. Addition resulting from acquisition. This property 2 here is for 2013. So this other side is for, how do they arrive at 500? Is property 1 and property 3, which is, property 1 is 100,000. The land is property 3. So you only look for those people that, those acquisitions that fall within the year for 2012. So that we have 2 here, which is 500,000. Okay. Then additions resulting from property under construction. Under constructions, we look at property 3. Property 3 under construction. Property 3 under construction, other office building. I think we have, this is 1st July. The cost 1st July. This is the beginning of the new year. Okay, look at this one, property 3. Carrying amount at a 30 June is 1.42. Can we see it?
Yes.
1.42, okay. So you can see that addition resulting under construction, 1.42. Addition from recognized subsequent expenditure, we have, there's no one here. For 2012. Then fair value. So we now look at all the fair values that fall under 2012. We can see it's only 45,000 for property 1. That's 45,000 there. So you bring it here. Disposal. The disposal took place in 2013. So there's nothing in 2012. So the carrying amount for the year, you now see how your 500 plus 1.420, then 45. So our carrying amount for the year is 1965. So this is our carrying amount in 2012, which we are going to carry brought down to 2013. You can see here. The carrying amount at the beginning of the year, it is the closing value here. The carrying amount at the end of the year, you are bringing forward here. Is that clear?
Yes. Yes.
Yeah. So once you bring it forward here, you now started, based on your calculations, you now started picking all those acquisitions, all those in 2013, because we are now in 2013. Let's look at this one, for example. Additional resulting from acquisition, property 2. Property 2, we can see that 1st of July, this is 1st of July 2012, 500. The land is 500. 1st of July 2012, because this is the beginning of 30 June 2013. Okay. We now see that 500 plus 1.1. This is the land aspect of it, and this is the building component of it. So 500 plus 1.3 is 1.8. So that's 1.8 you have here for 2013. The addition resulting from property under construction, that 370 the other time is here. Addition from recognized subsequent expenditure, 38. The fair value, you now put all the fair value together that fall under 2013. This 100,000 plus 110 plus, no, this is 2012, plus 12. If you put all this together, it will give you that 302. Then the disposal, the disposal is, came up, that is in 2013. So 145,000. You are going to take out the carrying value at the point of disposal. Okay, 145,000. Then the carry amount at the end of the year is this amount. So you can see that the investment property, this is the value you have for 2012. This is the value. So this is the value you are taking to your statement of financial position. So if you look at our statement of financial position, you will see that non-current asset, property, plant, and equipment, we are still going to deal with that one. And this is just one property. The investment property for 2012 and for 2013. So this is how you get the figure. Okay, so if you look at the property plant, we only have one asset that we treated under property, that is property 4. Property 4, we have the cost is 400,000. No, is it property 4?
Okay.
No, yeah, property 4. Land and building. The land is 180 and the building 918, the depreciation and the carrying value is 867. So that's one you would just treat it, that one under property, plant, and equipment. The carrying at the beginning of the year is 180, 180, 180 for both years. The carrying amount here, you start from 2012, the depreciation, and you work it down to get your, we did the one last week, then you transfer the balance to your, to the 2013 and repeat, I mean, the cost of property, the accumulated depreciations and all that. Then under your profit, those other things that came up in some of those things, you come under your profit. For example, the profit on disposal. You know, I was saying the other time, your profit of disposal is 280 minus 145. It comes in here. Then rent received. You know, there are some questions. Some of the property they receive rent will come under your income. Rent received per annum. I mean, per month times 12 months is this. The fair value adjustment, that 302, they are all gain. They are all gain. It's come under your income. The only one that we have in 2012 is that 45,000. Then the expenses, you now look at the repair and maintenance, 42,000. Then the depreciation will also come in here. Okay, this is a very comprehensive question. I don't expect that you have a question like this, maybe for example. This is just to expose you to, you know, how you'll be able to manage you know, this information on investment properties together with PPE. But I believe that PPE, if you are going to be assessed, PPE will be assessed on its own, and investment property will be assessed on its own. But if you just go through this, you know, the way we are doing it now, just if you take your time, look at those calculations, look at the calculations and see how we're able to organize them under the investment properties, pull all those things together, then be mindful of the dates and see how you are able to pull everything together to arrive at the figure that you will take to your statement of financial position. Okay, it might look very, but I'm sure but if you go over it, and then it will be much, much clearer.
Okay, it's very extensive. Sorry, sir, that 1.8.
Yeah.
Land and building, the 1,800,000. I see it's property 2, property 1 and 3. Which figure?
No, property 2, only property 2. You know what they did here? Property, yeah. The first one is for 2013. The second one is for 2012.
Yeah.
Okay.
And then what I need to know, that 180, which figures did we put together?
Oh, okay. It's property 2 now. Property 2. Property 2, you have 500 for the land. You have 1.3 for the building.
Okay.
So
right.
Just 1.8. Yeah. That is for 20. Yeah.
Where it came from. All right. Okay.
Yeah.
Thank you.
Okay, guys.
Thank you, sir.
All right, just
try
to practice with it. You'll be okay. But if during your if you are going through it, if you have any questions, please just note it down. By the time we come next week, we can quickly deal with that before we move on. Okay?
Okay.
Yeah.
Thank you, sir.
Bye.
Thank you, sir.
Bye.
Bye.